Hi, and thanks for tuning in to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. Today, I'm speaking with Ray Bernardo, Portfolio Manager at Madison Investments. Ray, great to have you on the show.
Good to be with you, Sumit.
Ray, you manage the Madison Covered Call ETF, ticker symbol CVRD, which launched back in August. Covered call strategies have been extremely popular this year, none more so than the JPMorgan Equity Premium Income ETF, better known as JEPI. How is CVRD different than JEPI?
The way that we're different from most other covered call strategies is that we're a very actively managed strategy, both on the equity side and on the option side. So on the equity side of the portfolio, we tend to invest in a very concentrated portfolio between 30 and 60 individual names. Right now we have 46. We tend to focus on very high quality companies with growing return on invested capital, free cash flow generators on a consistent basis, which typically leads to very high quality balance sheets as they have the ability to pay down debt. They also can pay out dividends, increase dividends, and have a lot of financial flexibility. So very actively managed on the equity side. On the option side, a big differentiator is that we utilize single stock options rather than index options. And the two primary benefits that we see from that are, number one, you typically will get a higher premium when selling a call option on a single stock option relative to an index option. And number two, and probably more important from our perspective, is that we can tailor the characteristic of each option to our view of the underlying holding that we're writing against. So for example, we may have a position at any given time that may be close to its valuation target. We may be looking to trim or sell the position, but we can just sell a call option that's very close to the money and bring in a higher level of premium. Similarly, another position may have more upside in our opinion. We can sell an option that's further out of the money, take in less of an option premium, but participate more in the upside. So we can really tailor the option strategy directly to our view of each individual company. And we think over the long haul, that can add significant value, even though it tends to be a lot more labor intensive than using index options, which are more of an umbrella approach to hedging the portfolio.
Great color. Now, Ray, your covered call ETF is new, but you've managed the Madison Covered Call and Equity Income Fund, which is a mutual fund, for a very long time now. What type of returns has that fund delivered, and do you expect similar performance for CVRD?
I've actually been managing the open-end version of the strategy since its inception in 2009. And the only significant difference between the existing legacy mutual fund and CVRD is that we've tightened up the guidelines around sector allocation. And whereas the mutual fund is really a go anywhere approach, we can periodically be significantly underweight or overweight various S&P sectors. We have somewhat tighter guidelines with CVRD. And the reason that we did that was to offer more choice to investors. The way that we do it in the mutual fund, which is go anywhere, allows us to make longer term calls on sectors. But periodically, we find ourselves being a little early, and you have to exhibit patience in order for the thesis to work out. So in the short term, there could be a lot more variability in returns relative to the benchmark because you may be underweight a sector that's outperforming, overweight a sector that's underperforming. So we took away some of that shorter term variability with CVRD. Now, ultimately, that go anywhere approach has worked well for the mutual fund. Our long-term track record is very strong. But in the short run, because we tend to be a little early, we can have the period of negative tracking error until the thesis plays out. And then the positive tracking error comes in and ultimately adds to the long-term return. Some investors don't prefer to have that shorter term tracking error, so we wanted to have a version of the strategy which minimized some of that sector tracking error. So that's really the only difference between the two. Ultimately, over the long haul, we expect returns to be similar and the income generation capacity to be similar as well.
Last question before I let you go, Ray. In what type of market environment do covered call strategies work the best? Is it accurate to say that they tend to do best in flat range-bound markets?
Well, I think in terms of market environments, covered writing strategies work in virtually any market environment. Uh, Probably the worst environment from a relative performance perspective would be in a straight up bull market, where the hedging characteristics of the option limit the fund's ability to keep up in a very, very strong bull market. But having said that, we will still participate in a bull market. We just simply won't get the high highs. And that's been really the structure of a covered writing strategy right from inception, is that you don't get the low lows when markets are performing poorly, but you don't participate in the high highs. You have much less volatile path to returns over time. So the worst environment is still an okay environment because you're still getting positive returns in a bull market. But in a sideways to downward trending market, you have the benefit of getting higher option premiums because typically in those environments, volatility is higher and option pricing is much more attractive. So that's where you get a much better hedge profile from the covered writing space. And again, focusing on quality with the underlying portfolio is critical so that you can protect with the underlying portfolio as the foundation of the fund, and then add downside protection with the option writing program.
Well, we're gonna have to leave it there. Ray, it's been a pleasure. Thanks so much for your time.
Thanks, Sumit. Appreciate your time.